Thanks for the time today. Thanks for the invitation to join the conference. My name is Andrew Davidson. I'm the CEO of Royal Helium, which is a junior helium producer and explorer based in Western Canada. Um, Now, I am forced to always start at the same place whenever I talk about Royal or helium in general, and that is, what is helium? Why does anybody care about it? What is it used for besides balloons? The short answer is it's used for many things that are far more valuable than balloons. The primary uses I've got up here on screen, and I just threw this slide together now, but historically, helium has been dominated by the healthcare industry and MRIs specifically, which use liquid helium as a coolant in the MRI process to cool the magnets as they spin. It's also used extensively in aerospace and defense, welding, lifting. But really, the more interesting uses now, the growth industries, if you will, are high-tech manufacturing, quantum computing, and the expansion of space exploration, which we still group into aerospace and defense. In all of these uses, helium, either as a gas or as a liquid, is irreplaceable. There's no other element that behaves like it, no other element that can do what it does. And so as demand in these industries continue to grow, and they do grow a fair bit faster than the demand of helium in healthcare, it's created a very large disjointing between supply and demand, which of course always translates into price changes. And we've seen that over the past 6 years. And when we started Royal back in 2016, 2017, the price of helium was trading around $100 US per 1,000 cubic feet, or MCF is the industry jargon. That price has moved now over $1,000 per MCF USD, based on the growth of these industries that are driving demand, based also on a declining supply. The regions that produce helium globally are few. I've got them listed here in terms of size. So we've got the United States, which historically has been the largest producer, producing helium as a byproduct from conventional natural gas wells. Followed by Qatar, which is in the same boat. It is helium produced as a byproduct of natural gas. Same is true in Russia, Algeria, and the newest up-and-coming producer is Canada, where we do not produce helium as a byproduct of natural gas. We produce helium as its own standalone product. And that's just a quirk of geology that allows that to be the case here in Canada, benefiting us to a large degree. Now, helium itself is explored for and produced exactly like natural gas. You complete seismic to determine reservoirs. You drill it like you would drill a natural gas well, and the gas flows under its own power. The curtailing of conventional natural gas drilling in North America over the past number of years, as people have shifted over to shale gas production, has had a material impact on helium supply, because helium is not contained within shale. In fact, shale is the only cap rock that can really hold it in place at depth, aside from salt domes. So that move has created a material shortage of helium in North American markets specifically, and has grown to a shortage globally. This is what creates the opportunity for companies like Royal Helium and some of our contemporaries in the world, as there become more and more helium exploration companies out there. Now, this is an overview of Royal, just a 40,000-foot overview. Our market capitalization there at 41 million Canadian dollars, an EV of around 69 million due to the net debt that we have on the balance sheet related to our production facility. 273 million shares outstanding, and a 42-week high or 52-week high low of 42 cents and 14 cents respectively. What sets Royal apart from other helium players, specifically at the junior stage, is the way we've designed our operations and facilities, such that we can capture not only helium, but some of the associated byproducts as well, and capitalize on those. And for us, the primary byproduct that we look at is CO2. And we made an announcement a few weeks ago about signing our first CO2 offtake agreement. So that's a nice piece of business that we get, and it really translates into Royal being more than just a helium company and really a junior industrial gas player. And that matters for a number of reasons. One, the more revenue streams you have, obviously, the better off you are. Two, industrial gas companies generally trade at a higher multiple than do normal production companies. So it was an interesting choice that we made. It's working out quite well, and it makes us unique in the market. Royal itself, we have one facility operating in Western Canada, producing the highest quality gaseous helium that can be produced, what's called 5 or 6 nines, meaning 99.999% pure. We do that at the facility that you see in the picture on the bottom here. That is our production facility. 100% of the helium gas that we produce and refine at that facility is sold under long-term contract into the space exploration industry. At an average price of $538 per MCF. So very, very nice pricing for us. In addition, we've got approaching 1 million additional acres of helium rights in Saskatchewan and Alberta. We've got 4 fields aside from our initial production field that we've already drilled and is waiting on a production decision, along with multiple other exploration projects that are at different points in the exploration cycle. That's Royal in a nutshell. Now, helium has been undergoing a pretty interesting change in the way the industry operates. Traditionally, helium has been produced as a byproduct, as I mentioned, and it's sold as an ancillary gas to an industrial gas wholesaler, an Air Products or an Air Liquide type company, who then repackages and sells to an end user. That has always been the case. It's one of the reasons why there hasn't been a lot of visibility in the helium market historically. That is starting to change now with the significant outstripping of demand versus supply has caused almost, I won't call them crises because that word's overused, but some significant demand and companies getting shorted on their allocations. And unlike some other commodities, with helium, if you run out, you simply cannot operate. This is true in virtually every use of helium that there is, to the extent that we get calls from hospitals in our office looking for liquid helium that they can put in their MRI machines, or else they shut down. These shortages are all driven off of this change in supply, combined with various geopolitical factors, be it Russia under sanction or tensions in the Middle East affecting Qatari production and exports. Canada has emerged as one of the safest jurisdictions in the world to produce helium. We are not the only ones doing it here. There are 2 other companies that are actively producing. One who has 7 facilities online now, and the other one has 1, as does Royal. This has caused a major move in pricing, as I outlined. And historically speaking, helium price has been governed by the US government, who maintained a significant store of helium in their BLM storage cavern in Texas. Annually or semi-annually, there would be auctions out of there for allocations for various industrial gas companies who would then take possession of the gas, repackage, and sell. That cavern and that whole helium storage facility and price management structure ended in 2018 due to lack of supply in the storage cavern. With that shuttering, there's been a move to more visibility on pricing. Previously, price was discovered once or twice a year on these auction sales. Now, it is governed by more market-driven metrics, where companies like ours can go and sell gas directly to the end user of the commodity versus selling it to a wholesaler who then marks the price up and resells it. This has been a material part of our business plan in getting from exploration through to producing company. And it's been quite beneficial both to us and to our customers. Our customers are saving money by buying from us, and we are making more money by not selling through industrial gas companies. As I mentioned before, we have locked in all of our production for 3 years out of our Steveville helium purification facility at a price of $538 per MCF USD. Very nice pricing. Considering when we started this company, we stress tested every property we bought using economics of 125. dollars. So when I mentioned this briefly, this is another paradigm shift in our industry between how helium has generally been explored for and produced versus how we're doing it. Traditionally, it's been very small regional plays where, helium is found in an elevated concentration in a natural gas formation and split off and sold. Those projects are always dependent on the economics of the natural gas, which was the carrier gas for them. It's produced and sold to industrial gas companies who then resell. We take a different approach. We've assembled a number of large resource plays and smaller profitable regional plays, and we package them into one company. Our projects are not dependent on the economics of natural gas. They are driven on the economics of helium alone. We own all of the infrastructure that we use to process and purify helium instead of using the technology of industrial gas companies and thus tying yourselves to them. And we sell the refined product to end users. And that's, a major seed change in industry. As far as we can tell, we are the first helium producer to sell directly to end user. And the ability of us to capture the other forms of gases that come up with our helium, be it methane, which we have at about 3% at our current field, and we capture all of that and we use it and convert it into power, such that we power our own facility and are actually a net power producer as opposed to a power consumer. We also have the ability to separate, purify, and sell CO2, obviously, as I mentioned earlier. Our only byproduct that is currently released into the atmosphere is nitrogen. We will be looking for a market for nitrogen down the line, but given that there's no greenhouse gas impact to nitrogen, we simply vent it. And we create some natural gas condensates as well, which we collect and sell. This is the Steveville Helium Plant that we completed in the fall of 2023. It is online now, building up towards its nameplate capacity of 15 million cubic feet of raw gas throughput per day. It produces a grade of up to 5/9 helium. In practice, we've seen grades above that coming out of our facility. We produce 22,000 MCF of helium per year sold under contract, as I mentioned earlier, and 20 million pounds of food grade CO2 per year, which we will be selling under contract as well, 8 barrels of condensate, and some anticipated carbon credit production of about $3 to $6 million Canadian per year. Based on the efficiency of the plant operation relative to any other plant that exists in North America. That's Steveville. Again, we are building towards that 15 million cubic foot a day capacity and have been building up since November of 2023. We are above 50% now, closing in on 75% of nameplate. We do not give timelines on when we're going to get to 100%. The plant is going to dictate that to us. This is what cash flow looks like from Steveville, and this can be extrapolated into any one of our other project areas. You can see the payback on a facility is very quick. The Steveville plant costs us in the range of 30 million Canadian dollars to build. The payback on that is less than 2 years based on the helium sales alone, not factoring in power sales, CO2 sales, condensate sales, etc. 100% return on the entire project, including drilling of the wells, happens in a little over 2 years as well, based on helium alone. And at year 2, 2.5, the cumulative cash flows from this one facility exceeds the total market cap of Royal Helium as a company. So very cash flow positive operations when at capacity. Enormous cash producers that run long term. Our wells run for a period of 10 to 12 years before they need replacement. The facility itself is engineered to last 25 years without major overhaul. So we created what we're calling a flywheel, which is basically a flywheel of projects that have the ability to spin up cash flow and allow us to advance more quickly every time we bring one on. Steveville obviously being the first cog in that wheel. Cash flow from that will be spun out and used to develop other assets within the company. We are the first public company in North America in the helium space to be vertically integrated all the way from production through purification to delivery of product to end user customer. We announced yesterday the signing of a major joint venture agreement with a First Nations group in Saskatchewan for the drilling of additional wells in the building of our second facility at our Val Marie asset in southern Saskatchewan. This is the first joint venture of its kind, certainly in Canada, if not North America or the world in general, as it relates to helium. A very interested party who takes a serious look at critical minerals, which helium is, and at the way that we produce and refine it in such a green and environmentally sensitive way. Again, the economics of Steveville justify the market cap of Royal alone. The valuation of our Val Marie asset, according to our joint venture formula, exceeds the market cap of Royal Helium. And if you look at it from that valuation perspective, you get the actual production and cash flow for free. Upcoming projects that we have, and we do have a lot, and we'll get into them, simply benefit from the proof of concept we've developed at Steveville. I mean, we know how to build these plants. We know how to operate them. We know how to structure the finance around them such that you can secure, Schedule A term debt to help build these facilities so you're not using equity dollars to do so. There is a path that you have to follow to get there, and we have defined it. This is what 1 million acres of land in Western Canada looks like. Everything in blue checks is Royal Helium property. We've got two different colored circles focused here. Everything circled in blue, whether it be Climax, Val Marie, Ogama, or Steveville, are areas that we've already drilled and defined economic grades of helium. The red circles indicate areas that we intend to get to in our next round of drilling. They would be called what we would call our high priority targets. And we've high graded them to basically 4. Obviously, the Val Marie project, which again we announced yesterday, is now under joint venture agreement for drilling and facility construction. We've drilled 1 well to date there. It will be part of the joint venture program to complete that well and get it ready for production. We anticipate the drilling and facility construction to begin relatively quickly and certainly within calendar 2024. Our 40 Mile asset, which is in Alberta, it's our most recent addition to the portfolio. It is a smaller land package and fits well within that package of smaller regional plays that can be quite economic. There is historical drilling on this property that tested specifically for helium. It returned grades of approximately 1% helium, which is globally in the top 1% of grades, and flow rates that would support the building of a facility of similar size to Steveville. Our Climax project is our most actively drilled project. We drilled 4 wells there back in 2021 and 22, returning economic helium grades of 0.35 to 0.65%. It is actively vying for a facility. It is in our sort of depth chart of deciding which property gets the next one, as is our Ogama asset, where we drilled 2 wells. Both of those wells returned helium grades of 0.6 to 0.76%. Additional testing on both of those fields are scheduled for 2024, at the end of which we'll make a decision as to which one becomes our third facility location. So this is the path that we follow in advancing helium assets. And when I discussed earlier about there being a specific pathway to get to the point where you can build these plants in a capital efficient way, this is what it looks like. Starts with very basic exploration, the same as you would do in oil and gas, and to some extent the same as you would do in mining. We review historical data to high grade areas. From there, we move on to acquisition of permits. Once we have those, we will complete aeromagnetic surveys looking for subsurface structures in the Devonian, Cambrian, and basement rocks. From there, we can narrow into a grid where we will complete seismic to get a better imagery of what's happening subsurface in our target zones. From there, we drill. And we drill just like any other oil and gas company would drill, using the same drilling rigs, the same crews, everything. The rigs that we use come from oil and gas companies that go back to oil and gas companies when we're done. Once we've completed the drilling and testing, we compile a resource report, what we would call a 51101 equivalent report, because helium is not covered by 51101 standards. And for those who don't know, that's the same as a 43101 in the mining side, except for oil and gas. Once we've defined that resource, we will enter into our first offtake agreement on the property. It will not be for the full amount of gas that we will be producing from there. It will be for a portion that is large enough for us to walk the project over to a bank and say, here's what we've got. We've got a resource. We've got an offtake agreement. We can specify the economics of this plant for the next 3 to 5 years and then secure bank financing to build the facility. And then we build the facility and bring it online and start deliveries to customers. The design and build period for a helium facility is anywhere from 7 to 12 months, depending on the supplier you're choosing and depending on market conditions. For us, our experience was it took a little over 12 months start to finish to get our plant, or our first plant designed, built, assembled, and operating in Alberta. This is the team that we built at Royal. You're going to have access to this presentation after, so I'm just going to hit some of the high notes. There's myself. I've been doing this for a long time in the helium space, one of the longest serving executives in the space. We brought in a new president at the start of the year, a gentleman named David Young, whose history is in private equity, having worked most recently at the Carlyle Group, one of the largest PE firms in the world. He left there and joined with us, having seen the build-out program that we have for our assets here in Canada. CFO, COO, and VP Engineering, I'll let you read up on your own time. Some of the more senior and important people we've brought into the project over the last year and a half are here. Mr. Carl Kurz is our most recent director. Before joining us, he ran a small oil and gas company called Anadarko, which then sold to Occidental for $55 billion US. He's currently the director of a number of multi-billion-dollar companies on the New York Stock Exchange. Again, as a petroleum engineer, he understands what we're building and how we're building it and enjoys the economics of it. Most recently, operating advisor with Ares Capital, a very, very large PE firm in the US focusing on energy. We brought in Mr. Brent Ziegler. Brent is quite simply the most experienced helium facility engineer in the world. He spent 20 years of his career working for Air Products International on all of their helium facilities globally, both gas purification and liquefaction. There's simply no better person to be consulting on helium projects from an engineering and production perspective than Brent. We brought in Brian Weston, who is the lead of land at a group called Encana, now Ovintiv, one of the larger energy players in North America, and Dr. Robert Stewart, who joined our advisory board for all things geophysics. Dr. Stewart's an MIT PhD in geophysics. He runs the Allied Geophysical Lab and is a tenured professor at the University of Houston. Here's our cap table. Relatively simple, 273 million shares out, a number of warrants, a smaller number of options, both warrants and options all out of the money at the current time. And there's another 31 million shares that are issuable upon conversion of convertible debt, which we raised in 2022 and 23 to help us build the facility. So we're fully diluted, 415 million shares outstanding. When you call us at our office, which I hope that you do, you're going to get either myself or Dean Nawada or Spiro Kletis, who are our investor relations team. I've been working with them for the better part of a decade. Forward-looking statements, everyone read that at your leisure. And that is a very quick 40,000-foot view of everything we are at Royal Helium, and I would very much enjoy taking any questions that there may be.
Excellent. Thank you very much. There's already one question in the chat. So is there also some natural hydrogen in the helium deposits?
We have seen that at our fields in Saskatchewan, specifically the Climax field. We had a number of results which showed free hydrogen in formation, as high as 11% free hydrogen in some cases. So quite frankly, we don't know what to do with that just yet. We have worked with the University of Regina. They have a hydrogen lab, specifically at their petroleum engineering college, determining the best way to exploit that and separate that on surface. Hydrogen and helium being very, very similar in molecular size, splitting them off is a challenge.
And given the transition from a pure helium explorer to an industrial gas company, how do you envision Royal Helium's portfolio evolving over the next 5 years?
Well, really, I see a path where we grow from 1 facility to 3 over the next 18 months. And once we get to that level of 3, there is so much cash flow coming off of these facilities that let us grow and acquire virtually any other helium or industrial gas company that's out there currently. I think that we're the natural consolidator for the industry, given that we're so far ahead of our competition. So we keep an eye on what everyone's doing, and when we think that there's a project there that is production ready or production capable, we take a hard look at it. We intend to grow internationally. We want to expand into the US market. And further, we'd like to partner with some of the larger players here in Canada, specifically a group called North American Helium, who have 7 facilities like Steveville's running now and are looking to grow to 9 of those facilities by the end of this year. Between them and us, we can certainly justify building a liquefaction plant here in Canada. It would be the first liquefaction plant in Canada. Currently, all of the gas that we produce gets hauled in these trailers you see on the left-hand side of your screen down to Colorado for liquefaction. The same is true at all of the facilities in North America. They all get hauled into the US to be liquefied. And they need to be liquefied because helium as a gas is an escape artist. And anyone who's ever bought in a helium balloon understands that. You know, on day 2 or day 3, that helium balloon is on the floor instead of in the air. And that's not because the helium wears off, it's because it literally escapes. And like these trucks that we have here are purpose-built helium hauling compressed tubes. And even from there, over time, helium will leak out. As a liquid, it's very stable. It can be stored. And so like with us, for example, with our customer uses the product as a gas, but they take delivery in liquid and they store it as a liquid and they regasify it for their own use.
And another question from the chat. So with the market cap so low compared to what your project suggests, it should be. Why do you think that it is? And do you see a reverse split in the near future?
Sorry, see a reverse split, a consolidation? Is that what? So no, I'll answer that question. No, we do not see a consolidation.
It's just coming straight from the chat, so I don't know.
Yeah. No, we do not see a consolidation in the future. The rationale for the market cap, I really can't provide other than, you know, generally every company in the very small helium complex of public companies has had a rough year. I would suggest that at some point value will be realized in Royal because of the fact that we actually produce cash flow now. We are less reliant on public markets than anybody else in our space. We are easily the most advanced. At some point, we will get recognition for this as we start making more news about, you know, the level of production that we're at this facility, commencing drilling at our other target projects. I think that helps a lot. So I wish I had a better explanation as to why we're stuck at 15 cents Canadian, but I just don't have one. It doesn't make sense to me. It doesn't make sense to anyone that's involved, frankly, but it is where we are. So, you know, we have our investor relations team reaching out to all these groups, explaining what we have going on, trying to justify why we're at 15 cents. We can't do it. And so we just put our nose down and we just continue to do our work. And that was evidenced yesterday by that joint venture announcement, which caught the world by surprise. In reality, we've been working on that deal for the better part of a year.
And as demand for helium grows in sectors like semiconductors and aerospace, what steps is Royal Helium taking to capture these emerging markets? Yeah,
it's a great question. And it's very relevant regionally as well as globally. So, you know, with the US onshoring a lot of its semiconductor manufacturing, it's created this enormous spike in local demand, right? And it's a tremendous opportunity for companies like ours who actually have volumes they can deliver into it. And finding customers as a helium producer is not the hard part. I mean, these customers come to us. In our first customer, which is, you know, the largest space exploration company in the world, called us to start offtake discussions. You know, groups majors in the healthcare industry reach out to us. So finding customers isn't a problem. It's really a matter of how quickly can you take a project from an exploration target to a defined resource and then build a facility on it and start delivering. All offtakes involve lead time. Ours was about a year between when we signed the first one to when we started producing. Currently, groups are looking to contract for production coming on in 2025. So you have to be in a position where you can build to meet that demand. And we are, and few others are, if any.